Good morning and a very warm welcome to the gambling industry. For today's session, we are on topic 4, where we're going to be unpacking product risk specific for the gambling entities. Today's session, we are going to be taking you through some general FIC issued guidance, as well as the sector risk assessments, and then also some international best practice dealing specifically with your industry. All right, so as at the beginning of every session, before we even start with pleasantries, we are going to then ask you to please fill in the pre-quiz or the pre-session questionnaire for us, as well as the attendance register. So as per normal, you will see that the moderator has posted 2 links. The first one is the attendance register. Please complete that. We will be sending confirmation of attendance as well as copy of today's presentation if your name is on that attendance register. And then the pre-session questionnaire again really is just to get a sense of where you're at. And then at the very last session, when we answer the last questionnaire, we would then be able to get a gauge of how effective our sessions have been going. So the questionnaire has been popped up into the Q&A box. We just asked them, we will give you 5 minutes on my clock. It is now 1:08. I'll give you until 8:06. I think 5 minutes. You guys are going through them like machines these days. So we'll give you 5 minutes then just to quickly fill out the, I beg your pardon, the questionnaire. Apologies, we do know that you are seeing a blank screen at the moment. We are still here. We're going to give you until 5:00, so we do apologize for not being able to project the front page. We're busy working on that quickly for you. Okay, great. That takes us then to 8:06. Thank you so much for filling in the questionnaire for us. If you haven't gotten a chance yet to do it, or if you're still busy, you're more than welcome just to complete it, preferably before we get started with today's session, so that we can gauge, the pre-session understanding on the topic. So as I've mentioned, today's session then is specific on product risk. We are going to be zoning in on the gambling sector. We had 2 sessions, or actually 4 sessions, morning and afternoon sessions yesterday. We spoke with the legal professionals, and we also spoke with trust company and service providers today. This morning session is the gambling sector, and then after you are going to have the property practitioners or estate agents, as they were formerly called. And then tomorrow we're all taking, I think, a well-deserved break, and then we will be back on Thursday and Friday. For those of you who might not have been in one of the morning sessions, just to introduce myself, my name is Ashley Moy. I'm here at the FIC, and I'm part of the guidance and awareness team. And as always, I'm joined by my team. I will hand over a little bit later to Yolandi Plykes, who's going to be taking you through the bulk of the presentation of actually unpacking the product risk factors. And again, as always, I'm supported by my colleagues also in the awareness space, is Spoo and Karabo in the background, who make sure that everything goes ahead without glitches. All right, so what we're going to be covering then, so the first 3 or 4 slides is going to be a very quick recap. It's information that you've already seen. Obviously, we spent a lot of time discussing the risk-based approach, understanding institutional risk before you can then actually go granular and understanding specific risks that your clients present. We are going to then do a very quick recap of the different risk factors that are required, and then also very quickly on the mutual evaluation findings and why we're zoning in on particular topics. We're then going to move straight into the bulk of the presentation. So I'm not going to waste too much time on the few slides. You'll see the next slide then shows us just some of the guidance that is useful to your area. As always, guidance note 7, which is that guidance product that was released in 2017, the end of the October, and that goes hand in hand with the application of the FIC Act. So this really talks about anything risk related. So from a risk-based approach to risk factors to questions you can ask and how you apply risk methodology. There's the FIC Act, then there's the risk-based approach for gambling entities. This is a FATF issued guidance document, and then the FIC SRA, so the sector risk assessment for gambling entities. And it's these documents then that really strip out certain risk factors and that we are going to be taking you through a little bit later. All right. Then, just like I said, a quick recap in terms of the Financial Action Task Force. Remember, they're the standard setting body. They sit in Switzerland, and essentially, so where am I coming from, Switzerland? Anyways, it was essentially what they do is they set the anti-money laundering and counter-terrorist financing standards. And essentially what these standards are is, if implemented within a country, we would find that that your levels of compliance with the standards would lead to an increase in, again, an increase in combating money laundering and terrorist financing. So that doesn't mean that we take the recommendations, the 40 recommendations, copy and paste it into our legislation. Obviously, within our framework, we have the Constitution, we have a certain legal framework, certain structures. We then need to make sure that the legislation or the rules that get implemented aren't in conflict with any other pieces of legislation, with the Constitution, and then obviously put it within our legislative ambit. We have implemented this through a few pieces of legislation, predominantly the Financial Intelligence Centre Act. There's also POCTATARA, which talks to the Terrorism Act, and POCA, which talks to the organised crime. So there's a few pieces of legislation then that unpack this. South Africa is a member of FATF. We're the only African member, and as a result of being a member, we then stand to be assessed. So through the assessments, essentially what this is a peer review where the representatives from the FATF, including the International Money Fund and the likes, would come through to member countries and then just do an assessment. There was two types of assessments. You get a technical assessment and then an effectiveness assessment. The assessment that we went under in 2019 was a combination. So from a technical perspective, they had a look at the legislative framework that I spoke about, just to check how does this align with the 40 recommendations. Have we taken the principles and have we applied them? And where we're not able to apply the principles, is there an effective workaround or is there effective explanation around why this wouldn't be necessary? And then from an effectiveness perspective, and that's always the second test, is okay, that's all fine and well that you've got it in paper, but how is it actually working? Are you implementing it? And what is the, what is the measure to make sure that it's actually working the way that it was intended to work? So in other words, are you actually combating money laundering and terrorist financing through the provisions that have been put in place? Under IO3 and IO4, so that's the first table, IO stands for immediate outcome. There's, excuse me, 11 core immediate outcomes, and these immediate outcomes are really taking the recommendations and putting them into themes, and then obviously from there being able to attest the effectiveness. So under IO3 or immediate outcome 3 is supervision. This really is the area that regulatory bodies like ourselves, as well as supervisory bodies like your provincial gambling boards and national gambling board, would be responsible for. There we got a moderate, and then from a preventative measures perspective, so this is really where accountable institutions' obligations sit, and specifically for designated non-financial business and professions, or DNFBPs, which is where the gambling sector fits in. Just a reminder that a DNFBP are those accountable institutions that are not banks or not financial institutions, right? These preventative measures relate to your understanding of risk, your risk-based approach, your RMCP, etc. Okay, so in terms of the IO4 outcomes then, so this is really that immediate outcome that impacts your sector. The general theme with regards to DNFBPs was the risk-based approach was lacking in some regards, and the risk assessments were rather static. They didn't take into account trigger events, they weren't up to date, and it generally just wasn't adequate enough. This obviously then started with business risk assessment or institutional risk assessment, understanding the risks facing your industry, understanding, from a sectoral perspective, is and your risk tolerance. And then the middle one there you'll see at the bottom is new products and process risk assessment. So products, understanding the product, understanding the risk associated with product was also a concern that was highlighted. Okay, so in terms, so what does that mean then? And again, if you have a look at the session 1 that we hosted, understanding risk goes from a national risk through to sectoral, through to business or institutional before you can get granular to your client. There needs to be a effective risk management. There needs to be a demonstration of adequately makes for these kind of situations. Okay, we are just going to ask the audience if the audience is able to hear us. We just want to check if our feed is working at the moment. Right, we're just going to test again. If the audience is able to hear us, I'm getting thumbs up in the background. So we do apologize. We also had posted, because we had seen 1 or 2 comments that you're not able to hear us. I don't actually know what happened. No one put themselves on mute. So I really do apologize for that. I'm not quite too sure maybe where we left off. I'm going to potentially just very quickly go over the last slide that we were discussing, just to make sure that you guys didn't miss anything. So the slide that we were on then was talking to the FATF recommendations in respect of the FIC Act. So with regards to recommendation 1. Now the thing is with recommendation 1, it's kind of the cornerstone recommendation that underpins the entire customer due diligence, which then talks to your monitoring and ongoing due diligence requirements. And this is really having an understanding of risk. It's not only for institutions to have an understanding of risk, it really goes from a national perspective. So nationally, as a country, what are our risk areas? And it doesn't necessarily mean industries that are high risk. It includes it, but it also includes certain factors or certain behaviors or certain transaction patterns, like the use of cash, corruption, for argument's sake, that get identified as money laundering, terrorist financing, and proliferation financing risks. We need to understand those risks. We need to boil that down from a national level into a sectoral level. You then need to take all of those learnings, unpack that, and see what that means as an institutional risk. And then from there, you'd be able to boil that down to understanding what risk your clients actually poses. All right. So that, I think, then is a very quick summary of the last slide. Like I said, sorry about the break in audio. I'm going to then hand over to my colleague Yolandi Plyke, who's going to be taking you through the product risk red flags, and then also just giving you a quick recap before we start on the different risk factors, just so you can remember where product risk fits in. And what I would like to ask of the audience is, in the back of your mind, please don't segment the factors. So we do have separate sessions, and we have separate sessions like today, for argument's sake, because your product risk factors are slightly different to that of an estate agent or a property practitioner, just given the nature of the business that you do. But what's very important, that there's always an overlap. So you'll see when we're talking product risk, in certain instances, we're going to say, okay, but does it allow for a third party? Does it allow for offshore? Does it allow for, transactions with a politically exposed person? Which in your mind, you're probably thinking about that's a client risk, or that's a geographic risk. So remember, these risk factors really are cross-cutting. Don't see them in silos, but today's focus really is around the product and everything associated with the product. So I'm going to leave it there, and I'm going to hand over to you. Thank you so much, Yolandi.
Thank you very much, Ashley, and good morning to all the viewers out there on this cold morning. Thank you for joining us. Just a reminder to complete the attendance register, and also any questions that you have, you can post it to the chat box. So without delay, just to get into the presentation, again, Section 42 of the Financial Intelligence Center Act, it requires that an accountable institution apply a risk-based approach. And a risk-based approach basically entails they must identify, assess, monitor, mitigate, and manage the risk that the provision of goods and services by the accountable institution may involve or facilitate money laundering or terrorist financing. Your risk-based approach must be documented in your RMCP, and very importantly, your risk-based approach gets done upfront, and it actually informs all of the rest of your controls that gets documented in your RMCP. So where you determine there's a high risk in your organization, you in a certain department, certain types of products that you provide is higher risk, you'll document that upfront and you'll state exactly what controls flow from that high risk, what controls you've got in place to mitigate the high risk. And yes, so please be aware that you need to demonstrate if an inspector walks into your institution tomorrow to conduct a risk an inspection on your institution, you need to demonstrate that you've conducted your risk assessment upfront, that it's part of your RMCP, and that it informs the rest of your controls of your RMCP. So Ashley has mentioned you have to conduct a risk assessment on a business level, an institutional level, looking at your organization as a whole and how it fits into the broader picture and what risks it faces as an entity. You also need to look at your client level. So that's when you onboard a client. Different factors come into play, and those different factors include, but are not limited to, what product and service you're offering the client, the delivery channel you're using to offer that product and service to the client, the geographic area that the client is from or that your entity is based in, the client type, and then also other factors. So for purposes of today's session, we are going to zoom into products and services specifically. Last week, we took you through client type risk. If you look at session, I think it was session 3, you'll see that we covered client risk in detail. And then today is product and services. On Thursday, we'll cover delivery channel, and then Friday, geographic area. So all of these factors combined when you onboard a client will give you a sense of whether that business relationship is going to be high risk, medium risk, or low risk. So these are the type of factors that you will take into account. With products and services, you'll see there whether or not it allows for third-party payments. So if you were to refund winnings to a client, if that client asks you to pay it over to a third party, it's a bit of a higher risk. Cash always presents a higher risk than a normal EFT. EFT is auditable. You can trace it to some extent, to a large extent in actual fact. Cash, if your client comes in with cash and they want to buy gambling chips, you don't know where that cash comes from. They can give you anything as a source of funds. They can say that that was their salary. You wouldn't be able to really check that because cash is not auditable. It does not have that trail. It's easily transferable. And so it is a choice within the criminal domain. Criminals often use cash and because of that factors. Cross-border flow of money. There's a risk there if your product allows for cross-border flow of funds. Again, when I'm stating these factors, some of them might not be applicable to the gambling sector per se, but you need to understand them and the broader risks in general. Okay, so let us go further into covering the how to risk rate a client when you're onboarding that client. So in this example, you'll see that the natural person was onboarded. We've scored that natural person scoring of 1. In that, it's very obvious when you're working with a natural person, it's very clear, you can understand more fully who you're dealing with. The product there is a day card. You've given that person a day card. Maybe that product is a higher risk in that the day card has higher limits. So there we scored them a 3. We see that the gambling is taking place closer to an airport. There is heightened risk factors when you are in an area closer to the airport. There's a lot going on at the airport's area. So there we scored that client, that geographic area 3. Delivery channel, non-face-to-face, that can be maybe online, an example, 3. But in South Africa, it would be face-to-face, and there you'd score it maybe a 1. Not employed, the person says they're not employed, so questions arise as to source of funds and so forth, so they will score 3. And overall, if that type of client in those circumstances was to be onboarded, you potentially see that client as a bit of a higher risk as a client. The second example there, a natural person actually operates as a junket. We know their junkets sometimes pool client funds and they act on behalf of other clients. So there might be a higher risk in that you're not knowing who you're dealing with, the ultimate person you're dealing with. So there you score 2. The client wants a high value loyalty cards. So there obviously there's high spenders in the back end. They want to spend their funds. Anytime there's a high value and high spending involved in gambling, it does pose a higher risk. So there we've assigned it a score of 3. A local town, they're based in a local town. They actually want to gamble in an area, in a casino that's based in a local town. So we've assigned it a 2. This is taking place face-to-face. And yeah, based upon that factors combined, you might say, hang on, this is more of a medium risk type client. Again, I just want to put a disclaimer out there. This is merely an example. Some of the factors might not apply to yourself, the type of characteristics such as non-face-to-face or so. It might not apply to yourselves, but this just gives you an example of how you can determine an overall risk rating within your space. It's important to understand how you've determined the risk scoring of high. So if you look at the right-hand side of your screen, you'll see there 3s or 1s are assigned, a 3 being a high, 1 being a low. But exactly how did you get to that point? And that's this type of rationale or unpacking of the understanding of risk is important for you to document in your risk management and compliance program. So what we usually say to all the other accountable institutions is, if you list all your different products that you offer, so you offer maybe 4 products in total, and those products are day cards, and then you offer services to junkets, you allow junket services to come, and then you offer also day cards with a low value point, and also loyalty cards. List all of your products and services, and then look at each of those individually and assess it to determine the risk. You can look at different factors that might impact that assessment. There's different sources you can rely on, like FATF guidance. You can look at international and domestic trends. You can look at historical trends within your entity and so forth. So for the first example, their product type, day card loaded with a large sum of cash. Already, when you're dealing with high sums of cash, there is an inherently higher risk. So there, the FATF guidance specifically states trends indicate that there's a higher susceptibility to money laundering, terrorist financing, or proliferation financing risk when you're dealing with cash. Cash is abused more by criminals. And also, if you look at the domestic setting in South Africa, you'll see trends indicate there is a higher risk. Also look at the Commission reports and other media reports that have indicated in a lot of instances where persons get paid in cash, illicit kickbacks or so forth, and they go gamble with those funds. So understand the heightened risk of cash whichever product allows for high values of cash being paid for that product would in actual fact be would pose a heightened risk. There are service type junkets, so you allow junkets to come in and provide services to their clients also. Again, look at international and domestic trends. Does junket services indicate a higher risk? Consider who is at the back end, the end client who's actually gambling. Do you fully understand that end client? Because that end client is the beneficial owner, obviously, in the scenario. So there it could pose a bit of a higher risk in that there's one level or one more layer in between yourself and the end user of your gambling services. Product type, day card loaded with low value. There you know that this client cannot gamble over a certain amount, and that amount is so low that it really mitigates your money laundering, terrorist financing, and proliferation financing risk. So there you can state that historical trends actually indicate, with historical trends looking back at your institution and how that product has been used by customers, you know that it's low risk, and for that fact you score the product as being a 1. Product type, loyalty card offered to high stakes rollers. So there again, high spenders within a casino environment. We always want to know, where does the funds come from? And there's always concerns around, where does this funds come from? Are they trying to use the casino to launder their dirty proceeds of crime and so forth? So there, that product type might pose a higher risk. If you look at international and domestic trends, it might pose a higher risk. So take that into account. So again, list all your products and services you offer. Assess each of them against the back of taking into account at least whatever guidance there is published specifically for the casino sector. And then you make an informed decision on whether that product is high, medium, or low. And you capture that in your RMCP. Okay, so I've mentioned a bit about sources. What sources can be used when you risk rating your different products and services? Well, you can look at trends. You within your organization, historical trends of how products and services have been used. Take that into account. There's also trends and typologies that is published by regulators. I know the FIC does publish trends and typologies. If you look on their website, you can download those type of documents, just read through them, read through the part that speaks specifically to gambling entities and gain an understanding of that trends and typologies. FATF guidance on a factor. So in a bit, we're going to go through the FATF guidance specifically relating to product and transaction risk. Then FIC guidance on a factor. So FIC guidance specifically on product and service risk, you'll find that in guidance note 7. We'll go through that in a bit as well. Then also what the FIC has done, we have provided a draft BCC 114, which actually sets out a very basic template and also provides guidance on how you can actually document your risk rating methodology in your RMCP as part of your RMCP. So that the draft BCC 114 is also quite useful. Also look at the FIC sector risk assessment. There they've also put certain information down that relates to product and transaction risk. We'll go through that in a bit. And like I've mentioned, If there's any international and domestic trends, take that into account. Your knowledge of a product, please apply your knowledge of, you are the specialist in your product, you know your product fully, you know the weaknesses and the weak points of your product. So apply your knowledge on that product as well when you're risk rating it. Open source information, commission reports, media reports, and so forth. If there's any media reports of groups of people that are laundering their funds through gambling activities and so forth, take those type of media reports into account and see if you offer similar products and services, see if you have similar clientele. You can definitely pick up trends through that. So then without delay, and again, I'd like to put up just to say that although not all of these type of factors that I'm now going to go through applies to your entity, a lot of them would. So when you are assessing your risk that the product and service poses in your institution, consider to what extent does the product provide anonymity to the client? Does the product enable third parties who are not known to the institution to make use of it? Does the product allow for third-party payments? Is another accountable institution involved in the usage of the product? There, I don't think that would apply so much within the gambling sector. Again, it's a general factor. The factors that are found in the FIC guidance, note 7, not only applies to the gambling sector, it applies to all of the accountable institutions. Can the product be funded with cash, or must it only be funded by way of transfer, like an EFT or so forth? How easily and quickly can the funds be converted to cash? Your gambling chips can be easily converted to cash whenever that person wants to cash out and just remove themselves from. How easy is it to do that? Do they need to go through all of the CDD and all of that? Is there a lot of checks and balances? Consider that to your product when you're assessing your product. Does the product facilitate the cross-border transfer of funds? There, not so much for land-based casino gambling entities. Consider other internet-based gambling entities. Again, this example is it might not apply within the domestic setting, but definitely where there's an internet service, internet gambling provider that operates cross-border, there's a high risks involved there. Is the offering of the product subject to regulatory approval and or reporting? There, your products are subject to getting approval from gambling boards or so forth. Again, when assessing product risks and services, as set out in FIC Guidance Note 7, what does the product enablement process entail, and to what extent does it include additional checks? The credit approvals, disclosure of information, legal agreements, licensing, regulatory approvals, registration, and so forth. To what extent is the usage of the product subject to parameters set out by the institution? For example, are there value limits on your day cards? What's the duration limits of cards that you offer out to clients? Is there transaction limits on your cards? All of that type of things might impact the risk. It might lower it or it might heighten it. Is the usage of the product subject to reporting to regulators or to the markets? Does historic transaction monitoring information indicate lower or higher prevalence of abuse of the product for money laundering or terrorist financing purposes? There, I'd like to, when you talk about transaction monitoring, there is, and I just want to pause there for a second, there is our Directive 5, which deals with automated transaction monitoring systems. So if you do have an automated transaction monitoring system in place, you also need to take into account Directive 5. and BCC 45. Again, guidance note 7, when assessing product and service risk, consider what is the intended target market. Is it entry-level clients or high net worth clients? Obviously, they're high net worth clients. If you are servicing clients that are spending a lot of money, there is heightened risk involved in that scenario, as opposed to a client that's gambling 100, 200 every couple of months or so. Are you servicing salaried versus self-employed individuals? Obviously, self-employed or unemployed persons pose maybe a higher risk from a source of funds perspective, as opposed to those get salary. So really your target market, and this target market is an overlap between your client risk factor and your product risk factor. Is the usage of the product subject to additional scrutiny from a market abuse or consumer protection perspective? What is the time of duration for conversion of funds? Again, can chips be converted to cash easily? Can whatever values on your loyalty card be converted to cash easily, and vice versa? Is the product an industry regulated product? Does the product allow for a flow of physical cash? Are there specific conditions that must be met or events that must happen for the clients to have access to the funds? Does the usage of the product entail structured transactions? Does the transaction volume, what is the transaction volume at least facilitated by the product? So again, if the product allows for high spending, there might be higher risk. Does the product have a cooling off period? This type of factor wouldn't really apply within the gambling sector. Again, these are general factors. They apply across board to all accountable institutions. But there are of these factors that would apply within your space. Are the products offered short-term or longer-term contractual relationships? Do products require payment from the same name, account, facility to facilitate the opening of a product? This one is quite important within the gambling space. If you allow casino accounts, where are payments coming from to the casino account? Must it only come from client, or can it come from some other third party? Obviously, if it comes from a third party, the funding of that casino account, there's a heightened risk involved in that type of scenario. And then we will go on to FIC sector risk assessments on gambling entities. So if you look on the FIC website, you'll find this sector risk assessment. It was published in March 2022. And it basically provides a snapshot of the sector risk assessment conducted by the Financial Intelligence Center on the gambling sector. So here too, I'd like to state that not all of the examples will apply to all of the entities. So take that into mind when I am going through these examples. So again, factors highlighted included. Obviously, as gambling offers several diverse products, they carry different risks. So if you look at certain casinos, what the findings was that some of the casinos more commonly offer loyalty cards than day cards. There was also findings made that day cards require verification measures to mitigate the anonymous loading and withdrawal of money on cards. So again, product risk. When you're designing your product, your loyalty card and your day card, there just check what is your customer verification controls that apply to that products. Obviously, make sure that's in line with FIC Act. to mitigate the risk and also to comply with FIC Act. Most of the operators use gambling chips in their casinos and do not require patrons to cash out their chips when leaving the casino. Where a casino is part of a group, it's allowed for patrons to use gambling chips at different branches within a group. Casinos are legally obligated to have online monitoring systems in place. These monitoring systems are used to a large extent to track cash movement between players and the casinos. The players, so there, in the scenario, if your product allows for a patron to leave with that gambling chips and go and use it at another one of your casinos that's in your group, again, it makes it a bit more difficult to track that player's spending. There might be a heightened risk in that regard. Again, it might not apply within your casino at all, but if this type of scenario does apply, it might include a heightened risk. Route operators, it was found that the majority of route operators are relatively large role players, having more than 100 gambling machines licensed to them. Clients are only identified and verified when the payout exceeds the predetermined amount of cash threshold of 24,000. Year 2, if your product or service allows for enables clients only to be identified and verified at payout stage, consider that as an heightened risk. Obviously, you need to identify and verify all your clients in line with the FIC Act, and that states that if it's a single transaction exceeding 5,000 Rand, you would have to identify and verify your client. So be cautious how you set up your services. Ensure that it's in line first off with the mandatory FIC Act requirements, and then thereafter risk assess it and based upon what it enables the client to do, it might pose a higher risk or a lower risk. Site operators, the extensive use of cash by site operators was evident. Again, the requirement to identify and verify payout stage was highlighted, and again the threshold that identification and verification was linked to came into play. Bingo, the practice of only identifying and verifying clients when payouts exceed the reportable cash threshold. Again, that's a heightened practice within the gambling environment. Betting through bookmakers. Some operators use a combination of on-site, online, and telephonic bet placement. Online betting makes it more difficult to correctly establish and verify the identity of a client, and in instances where a client has already been identified, to verify the actual account holder. This may potentially increase the money laundering risks associated with that sector. Bookmakers who receive deposits via EFT do not conduct CDD, customer identification and verification, prior to providing such customers with their banking details. So there, that might enable the risk of some third party actually making a deposit into the bookmaker's account, and afterwards a person who states they're the actual client comes in and provides their CDD information. So that practice of providing banking details there before conducting CDD, that does pose a heightened risk. So if your product or your service enables that, it's definitely a heightened risk, definitely not in line with what is prescribed in terms of the FIC Act as well as BCC 31. Betting through totalizers, the FIC sector risk assessment states that totalizers pay their clients in the form of combination of cash and EFT payments. Clients are identified and verified prior to placing of bets at the payout stage. There is scope for anonymous transactions to occur, and the identification and verification of clients is not consistent in the different gambling institutions. The value of winnings, as well as the fact that clients can place bets non-face-to-face, makes the money laundering risks associated with the products and distribution channel higher or high. So that was in a nutshell, and I've covered it very briefly, the FIC sector risk assessment. You can go onto the FIC website and download it and go through it at your will. Further then, I'm going to focus on the FATF guidance. That is specifically, so we've extracted the portion that specifically is aimed at product risk assessment. That comes out of the risk-based approach guidance for casinos. So there, the FATF guidance states that when you're assessing the risk that a product and service poses, you should consider the following as posing heightened risk. So there, obviously, you need to take into account the casino's operational aspects, whether the casino is land-based or internet-based. Obviously, that would impact the risk, the overall risk. Again, in the second bullet, you'll see that high spenders has been highlighted as a risk. So you need to pay attention to high spenders or high rollers. The proceeds of crime can come into a casino in any manner. I've highlighted cash as a risk, but also credit card and debit card fraud. So understand that not only cash poses a risk, you need to understand when you're dealing with a high roller, funds can come in any form, be it EFT or cash. Obviously, in the third bullet point, cash does pose a higher risk, a heightened risk. Their customers may use a land-based casino to exchange large amounts of illicit proceeds for smaller denominated bills. At least smaller denominated bills for larger ones. Obviously, larger ones are easily transportable and so forth. So that is a form of laundering funds, processing that funds, forms of layering the funds to get it to a point where they can use it freely within the financial setting. Also, certain cash deposits by a customer, especially cash deposits which are considered relatively large in relation to the casino's average receipt of transactions, and also in relation to the customer's financial status. So check whether or not a cash deposit is in line with the client's profile, and then also is it in line with the average type of receipt of cash by that casino. The majority of payments to internet casinos are made directly from financial institution accounts. However, internet casinos can operate as part of mixed gambling chains, which also include betting shops or land-based casinos. It is possible for customers to provide land-based outlets with cash, which can then be credited to internet casino accounts. Internet casinos should work closely with their land-based counterparts that initially receive the cash to ensure that CDD measures are applied appropriately. So there, if that casino offers both land-based and internet, and the land-based obviously accepts cash, it's easy, and that client can use it then to proceed to gamble online or so forth. There's definitely a heightened risk of money laundering involved in that type of scenario. Again, I'd like to point out these type of examples might not have application in the domestic setting, within the casino setting, within the gambling setting within South Africa. It's important to understand, and when you do develop future products or so, that understand this and apply it within your future product setup. So then further FATF guidance, transfer between accounts. If internet casinos wish to allow internet account transfers between their customers, they should devise careful policies and procedures which monitor the amounts that are transferred. Informal money lending can be illegal. So there again, borrowing between customers of a casino, it enables basically an opportunity for to introduce at least the proceeds of crime. So there it states informal money lending can be illegal, and it can also offer criminals an opportunity to introduce proceeds of crime, usually cash, into the legitimate financial system through the casino. Again, this can pose a heightened risk. There, loan sharking was highlighted. Casinos in some countries have a problem with this activity, which is a crime that involves loaning money to individuals at an interest rate which is above the maximum legal rate, sometimes collected under threat of violence. Loan sharks may be financed and supported by organized crime networks. So if you're operating a gambling entity within environment, you might become aware of certain persons that operate around your entity within the community or so, and if those persons are known for this type of behavior, lending funds or so to your patrons, understand that is also that also could be some sort of organized criminal network that's trying to siphon off or launder funds through the use of patrons that are then given funds, and they go to your casino, gamble at your casino, and whatever proceeds or whatever gets then paid back to those type of loan sharks. If you see in media reports and so forth, also where random people from the streets or so forth are given funds by criminals and stated, go open a gambling account or go with a day card and gamble, and whatever proceeds you get back, so that risk does, it is prevalent. Again, the FATF guidance, and again, highlighting not all of these considerations would apply to your entity, but where it does apply, please do take it into account. Use of casino deposit accounts, that is where a casino offers some sort of a casino account, and where the customer actually abuses that account and uses it as a transactional account or so forth, and not for purely gambling purposes. So casinos need to consider what constitutes an abuse of such an account, and also the casino must have controls in place to prevent the abuse of the accounts for these type of purposes. Redemption of chips, tokens, tickets, or tokens for currency. Casinos in some countries do not require that customers provide identification for redemption of chips, tickets, or tokens unless it triggers government reporting thresholds. For a customer that has an established casino account number, an established at least casino account number, a casino which is not required by governmental regulations to record such transactions at the cage, nonetheless should have policies, procedures, and internal controls to identify large redemptions to such a customer that was paid with currency or so forth. Okay, so there, you need to be able to identify, regardless of what product or service you have in place, wherever there's a large redemption, you need to be able to pick up on that and also assess it to determine whether there's anything suspicious or unusual about it. So if your product allows for large redemptions, you must be able to monitor those types of large redemptions. So there's specific transaction issues which apply to internet casinos. They, again, within the domestic setting, might not have application, multiple casino accounts or casino wallets. Their internet operator may own and control multiple websites. Single websites can also offer a range of different types of gambling. Operators will need to monitor customers' aggregate positions across the whole of the casino business. So there you need to monitor the client's aggregate position across the entire casino operations. This in order to identify where customers are opening multiple accounts or wallets for dishonest or inappropriate reasons, including attempting to obscure their spending levels or avoid checks undertaken at a threshold level. So obviously in South Africa, we've got this cash threshold that applies. So the minute a client deposits cash above 24,999, it would trigger a report to the regulator. However, if the client seeks to open different types of accounts, in order to deposit half of that 24,000 in one account and half in another account, in order to specifically avoid that reporting level, which they are aware of, your entity needs to be able to pick up on such type of behavior and then report that through as you would a suspicious and unusual transaction report. Changes to financial institution in accounts. So again, when a client opens a casino account, they give their financial institution account number. With that financial institution account number, where they want to change it in time to come, or where they seek to change it, that sort of change should trigger an updating of customer due diligence. You would not want that client to change it to an account of a third party or so. So definitely make sure that that would trigger some sort of due diligence process then. Again, this is still applicable within the internet-based, so identity fraud. Details of financial institution accounts may be stolen and used on websites. Stolen identities may also be successfully used to open financial institution accounts, and such accounts may also be used on websites. Internet provider number checks are useful in preventing criminals from opening multiple casino accounts using stolen identities. So multiple different accounts may be opened with different stolen identities, but it might be traced back to the same internet provider number. So that's a clear giveaway that something is wrong, and that's something that casinos abroad internationally can also track. Prepaid cards, using there's often scope for using cash to fund a prepaid card, and that obviously poses the same risk as when cash is used. So there again, understand that risk, understand if patrons can use prepaid cards within your environment, understand that they can fund those prepaid cards with cash. Electronic wallets, not all electronic wallets are licensed in reputable countries, and a number of e-wallets accept cash as deposits. Again, cash is a risk within a gambling environment, and if you don't know that cash came in at the entry point through an electronic wallet, that might pose a risk. So then finally, before I wrap up, and again, this is a FATF guidance of abortion, and FATF guidance is aimed at all international type gambling entities. So of the examples might not specifically have application within your setting, but it is important for you to know and understand when in time to come you do develop new products, you might apply these type factors. Games involving multiple operators. Poker games often take place on platforms shared by a number of different casinos. The platform is likely to play a key role in monitoring the pattern and value of play for potential money laundering activities. So out of all the factors combined that is set out in the FIC guidance product, FIC sector risk assessment, as well as the FATF guidance product, you can definitely see there's certain patterns, there's certain key similarities that you can pull out from these guidances and apply when you are risk rating your products and services. First off, obviously cash. Can it be funded by cash? Third parties, does it allow for third-party payment, funding, or payment out, redemption or return of funds, high rollers, high spenders, player risk. Where there's any third parties like junkets or so involved, it heightens the risk as well. So pull out those similarities and apply it when you're doing your risk assessment of your products and services, and document it also as part of your risk methodology in your RNCP. So that's exactly what I've stated. Document it in your RNCP, the manner in which you assess risk and apply it within your environment. Obviously, if there's a higher risk, you'd apply enhanced controls. If there is a lower risk, you would apply what's referred to as simplified controls. So that being said, I will then hand back to Ashley and see if there's any questions on this topic. Thank you very much.
Great, thank you so much, Yolandi. It was a lot of content, and we always remind our viewers, please don't get bogged down in the content. There's a lot of meat and a lot of words, because we are providing you these slides so that you can read them a little bit later, and there's nothing worse than seeing two words next to each other and you have no cooking clue what it is we were trying to refer to. So if it seems a little bit meaty, we've tried to put certain keywords for you. We've bolded them just so that you can really identify the key principle out of that particular paragraph. Having said that, there were a few questions, but before we get into the two questions, there were two very important points that Yolandi had raised in her presentation that I maybe just want to quickly pause on. The first one being around what we like to term a blanket approach towards risk assessments. So there are certain organizations, and we have seen this in some instances in the gambling sector. So when we had a look at like your client factors, for argument's sake, we do understand that your interaction with corporate clients is probably going to be very limited. So if you're dealing with like loyalty cards, junkets, etc., there might be an engagement with a corporate entity. But when you're dealing with the actual gambling itself, there always has to be a natural person behind that transaction that does it. And oftentimes what can happen is one can overlook the potential risk there. So if we're saying as a general principle, corporate structures do present a heightened risk as opposed to individuals, there might be a stance to say, well, okay, well, we obviously only deal with individuals, so therefore they're all going to be low risk because a corporate presents a heightened risk. And we really want to caution you against that kind of approach. And the reason I say that is and it boils down to your institutional risk. So if you're looking at your institutional risk or the risk that your organization or that your gambling entity faces inherently, you know that you're dealing with individuals. So now if we're dealing with individuals, we have to really zone in, and areas that you might be focusing on is, how is an individual going to use a particular product? Does my product allow for the payment to a particular individual, as well as would that payment also allow, or would this product also allow a payment to a corporate structure? So even though you don't necessarily gamble with an individual, that payment or that product might allow for a payment to a legal entity. So just be careful from that respect. And also, we don't apply a blanket risk approach. So we can't say I've only got individuals, therefore they are all low risk. It is possible, however, that your individuals are, or your individual clients are low risk, but you would have to have gone through an assessment, you would have to have applied your risk methodology, and at the end of it, if your results indicate that these clients are low risk, then so be it. But you would have to evidence how you've come to that determination. The second thing that I wanted to mention was just with regards to the evolving nature or the dynamic nature of what an RMCP needs to be. And just a reminder, when you're having a look at an RMCP, it's not just a document, it's the program that is implemented, and then you have to document this program. And Yolandi had mentioned, when you're looking specifically at your product factors, there's this thing called, I think the section was around learnings. So if you have upfront said that this particular product is a very low risk, but after a monitoring exercise, or after a year or two, and you start dissecting the STRs that you're submitting, because remember, that's also critical information. If you are submitting an STR, and in that STR you continuously see a particular type of product or a particular type of service, keeps cropping up in your STRs, but you've actually originally listed it as a low, that is a very important trigger event, or it's a very important source of information where you can actually start making your review more robust and make more sense for your organization. And that really just talks to the dynamic nature of risk factors. And it also boils back to the critique through the mutual evaluation report, where they said a lot of the risk understanding, or RMCPs, tend to be very static. So I think that was a very good example of how you can use your understanding through your account monitoring, your client monitoring, the submission of your CTRs and STRs, have a look at what products are flagging, and I guess you can use this across the board for your other risk factors. So you can also see, what geographies are flagging, what type of client types are flagging, and how that interplays with your product risk. It will be a very useful tool to make sure that your RMCP is accurate. Okay, so I'm going to pop into the questions. We've got about 15 minutes left. I did note 3 questions which we're going to go through, and if there are any more questions, you're more than welcome to pop them through quickly. The first one, I think it comes from a supervisory body, and the question says, to ensure that there's not a disconnect between the FIC, supervisory bodies, and accountable institutions, and to further ensure adequacy and relevance, to which extent will the FIC be involved in the review, implementation, and monitoring of a risk-based approach and a uniform risk assessment and reporting for all gambling sectors? Okay, so I think there's quite a few elements to this. So from a supervisory perspective, as you're aware, there is an pending amendment to the schedules, and I'm not too sure if anyone was watching the Parliament TV on Wednesday, where Peter Smith and Ishmael Mamomiat, the acting DDG of Treasury, was presenting to Parliament on the status of where we are from the schedules. And part of those schedule changes under Schedule 2 was referring to the change in supervisory bodies. So there is a view for the FIC to take over the supervisory functions, but we obviously can't do that in isolation. The gambling, the licensing authorities for the gambling sector obviously have been your supervisory body and continue to be your supervisory body, but they have partnered up with the FIC with assisted inspection. So you would note oftentimes you might see a FIC representative along with a licensing authority official performing those reviews. So from a schedule perspective, when the FIC is going to take over as a supervisory body, in conclusion of that session, that parliamentary session that took place on Wednesday, Parliament is breaking for recess. They're going to come back, I think, July or August. And then thereafter, there may be a consideration, because remember, these schedule changes needs to be approved at Parliament level. We can't just change it. And there was a call coming out of that session that they wanted public consultation. So whether that be through an open sitting or whether they're going to request more or call for more comments, we're not too sure exactly what Parliament is requesting for that. So to answer that part of the question, we're not the supervisory body yet, but we do have a strong relationship when it comes to the inspectorate arm of it. We are also then calling, so as remember, we spoke a little bit earlier about immediate outcome 3 and immediate outcome 4. So immediate outcome 4 talks to preventative measures, and this is really around your understanding of risk, how you implement it, how you implement your controls, the FIC Act obligations, etc. Then there's immediate outcome 3, which talks to supervision. Now, part of that supervision requirements, if you look under immediate outcome 3, is as a supervisor or as a regulatory body, we need to have a very good understanding of the different industries that need to comply, obviously including the gambling sector, and we need to make sure that you have enough information and awareness so that you can draft and implement an effective program, and then also document an effective program. As part of that, what we have undertaken is there's been a selection of 30 of the top players, if I can put it, across the DNFBP sectors. I know in the gambling sector, the numbers might be a little bit greater, obviously, because you know, you're a much smaller in terms of numbers, not in terms of value, but just in terms of the amount of entities in your space. And as part of that initiative, you might have received letters already. We've called for copies of RMCPs. We then are going to go through a process of reviewing the RMCP. So it's not a case of vetting it, because it's not something in our power that we can do. But we will be going through the RMCPs, and we will be guiding these institutions of where they've gone wrong or what they've done right. And most importantly, is we're going to take those learnings from these RMCPs and from reviewing these RMCPs and feed that back into your industries. So it's not a case of, you know, people being singled out so that we can mark your RMCP. It really is a case for us to be able to demonstrate to the FATF that there has been a marked improvement since 2019 of their review. So with that context, I think it was important that I give you that bit of background before I answer this. So how is the FIC going to be involved in the review, implementation and monitoring of a risk-based approach and the uniform risk assessments? So that is our project. That's what we're trying to do, so that we can get a very good understanding of where your RMCPs are and feed that information back in. Obviously, from a risk-based approach, that talks to how you understand, you know, your institutional risk, your business risk, how you've documented that, how you implement it, and that then feeds through to how you actually implement your program. That is going to be part of the RMCP review, and you will be getting feedback, and industry will be getting feedback on that. We obviously cannot tell you how to implement a risk-based approach. We can't tell you exactly which factors and what decision you need to make when, because that kind of goes against the risk-based approach, but we can equip you with enough information and how you make that determination, which is where I think this risk program is also a very significant step in that direction to aid you. The last part then, in terms of a uniform risk assessment and reporting. So, excuse me, PCC or draft PCC 114, we're hopefully going to be issuing it very soon as final PCC 53. So hopefully by the end of June. We're only a month behind. That then has a template. It also breaks down what needs to be in the program. There's 5 core areas in that program. So if you have a look at topic 2, where we took you through this PCC, that is kind of a templated approach, not to copy and paste or plug and play, but at least to guide you in what would be sufficient. Okay. The second, oh, sorry, Yolandi, anything else? I can ramble on for days. I always forget. No, she says I've covered it. Our jurisdiction is limited to legal, licensed and regulated gambling. What is the fixed approach to illegal gambling? So this is kind of an easy one. If you have a look at our schedules say accountable institutions are those within particular parameters. So if you have a look at the schedule, and again, I always have my little bookie with me because you never know. The schedule, then I just want to see exactly what your definition is. So if you have a look at your definition, it says that you are is gambling. Any person who carries on the business of making gambling or gambling activity contemplated in Section 3 of the National Gambling Act, of which a license is required, etc., etc. So that definition is important because that sets out who the accountable institution is. If it is illegal gambling, my take on it is, well, then that is a proceed of crime. So any funds that come through illegal gambling, obviously, if you're doing something illegally, you're not going to register with us and you're not going to report it, because why would you why would you do that? So any funds that come from that would then lead to a proceed of crime. Should they come through your organization, should it come through the financial institution, so whether it gets deposited at a bank or whatever the case may be, they also would be able to pick up from where these proceeds came from. If it came from gambling activities per this, per the licensing authority and through your legislation, it's fine. But then again, if it was illegal activity, then that would amount to money laundering and that would follow the reporting process. Okay, I'm just checking, Landy, anything you wanted to? Okay, you're just going to shoot then if you want to jump in. Okay, sorry, my screen is just a little bit stuck. I can't seem to get to the next. Oh, there we go. Do you have to identify and verify clients where they start gambling? So I think this is a, I'm going to maybe pop this one over to Yolandi. So Yolandi, the question reads, do you have to identify and verify clients when they start gambling? And then there's a reference specifically to online gambling, or I beg your pardon, online betting.
You have to, so there is a form of delayed verification. And if you look at guidance note 7, it sets it out quite well. You can start with a transaction and you can start with onboarding a client, but you cannot finalize a transaction before you've actually identified and verified that client. So I think in the scenario given, the actual action of that person coming in and having gambled, and I'm just trying to see the example. I think I've read it in context with another question. So you have to, so the transaction would be the act of gambling in that type of scenario, and you'd have to had identified and verified the client. So the client could either win from that gambling activity, or the client could lose all their funds from that gambling activity and just leave the casino. In that instance, that you wouldn't want that scenario to happen, because obviously then there, and it is linked to a later question I see. In that scenario, you would have dealt with an anonymous client, which is not allowed. So there is a form of delayed identification and verification, but you must make sure it's done before the conclusion of a transaction. And obviously in your guys' space, a transaction would be the act of gambling in that sense. I don't know, Ashley, maybe if you want to add. Thank you.
Thank you, Yolandi. I think you definitely covered it previously, and I know where this, not confusion, but where this issue came in is there used to be exemptions under the old act that spoke about timing of verification, and obviously all the exemptions fell away. There was also, certain limits and thresholds which fell away. So from a FIC Act perspective, if you're dealing with a particular amount, so if you're dealing with 5,000 and above and it's continuous, then obviously that then relates to a transaction in for purposes of the FIC Act. Section 20 capital A says no anonymous client, so you wouldn't be able to enter into any transaction with an unknown person. So so it's difficult for us to answer this kind of question, because by the time you've gotten to that situation, you're already in breach, because if you've concluded, funds have been received, funds have been paid out, it depends really on what your definition of transaction is. You're too far gone. You've already you already haven't complied with the obligation, and not only from a CDD perspective, as you wouldn't have enough information to submit a suspicious transaction report. So it really is a fine balance. When is the concluding of a transaction is something very important that you need to consider in your program, and how do you document that in your program? And that's a very clear risk. You run the risk of non-compliance dependent on your timing. It's I think that's also the beauty of how you can use your existing products to prevent this kind of behavior. So for day cards, for example, that's very easy when, or returning clients, if they have these, loyalty cards, however much they could present a heightened risk. From a money laundering perspective, they may also assist you from a customer due diligence perspective. So you've performed it, they come back, you don't, there isn't that need to continuously update your CDD because it's something that's already been done. Okay, but just make sure you don't put yourself in a position where you don't have any information on the client. You have questions or making general inquiries, who's the contact person. So we do have a dedicated call center. So if you have any issues around how to update your registration profile or how to submit a report, or your report is stuck, or whatever the case may be, so anything registration and reporting related, you're more than welcome to give our call center a call. If it's a little bit more complex, if you've got a question regarding the application of the Act, we would then ask you to submit a written query through to the FIC. The reason why it gets written is because it obviously needs to get stored on our database. It goes through a quality assurance process, so we make sure that we are giving you an adequate response, and that is available on the FIC website under Contact Us. Then you can just submit through a written query there. Okay, I think those are all the questions that we addressed, and I know that last question around payout and clients leaving without performing transactions always seems like a wishy-washy answer from a regulator, and I always feel bad not being able to tell you exactly the answer, but that's really something that you need to determine from your processes and put that into your program to make sure that your CDD process is effectively managing the risk. Okay, so I'm going to leave it there. Then I know we've got 3 minutes. We don't have any other questions that have been. Yeah, just check. We've got no other questions. So I think we can break it there. Like we said, tomorrow is a day off for all of us, and then we'll see you again then on Thursday along with all the other industries. So this was the only breakaway session, and we're going to be discussing, I think it's distribution factors or geographic risk. I can't remember now off the top of my head which one of the two it is. But we'll end it there. Thanks so much for joining us. All the best. Keep well, and we'll see you then again on Thursday. Cheers all.